expect that valuations will go up and down more and more in a more and more volatile way because the unit on which they are counted and valued, which is the US dollar, is getting more and more shaky. So you'll see crazier and crazier rallies followed by crazier and crazier sell-offs, and this will get more and more and more volatile until the very unit with which we measure these things collapses entirely.
And think about this. So right now, the average gold producers, some say, is between $1,200 as little as $20 to maybe as high as $2,000 as their total in cost. That's what it costs them, and then whatever they get extra for that. Well, now they're getting twice as much as that, but $1,000 more would be 150%, and their expenses aren't going to go up that much during that time. So that's where you see the real leverage. That's, as we like to say, a lot of us have been saying that follow them, they've been legally printing money with record free cash flow, and that's only going to continue more and more here for the next several quarters.
What's my macro view? I don't like the word macro because I don't believe in macroeconomics. I believe the whole system is on the verge of complete catastrophe, and that's a good thing. I don't use that word to say that we're all going to die or anything like that. Everything eventually will be fine, but there's going to be serious restructuring of everything because the dollar is dying. What am I looking at now? I'm looking at the action of precious metals. I'm looking at the precious metals versus mainstream stocks, which is the precious metals are only now just starting to outperform stocks. They haven't been since 2011. I'm watching the Fed about to cut interest rates into a worsening consumer price environment, which they haven't done since the 1970s. I mean, what happened in the 1970s. And I'm watching the whole world lose its mind and get more violent, and welfare recipients get more crazy by the day, and societies start to break apart. So I'm not interested in investing in anything. I'm interested in divesting because I see everything is about to collapse. By divesting, I mean getting out of all debt, right? And the dollar itself is an instrument of debt because all dollars that are issued that exist today were brought into existence in exchange for treasury bonds that the Federal Reserve bought. So the dollar is debt, and therefore to invest in dollars, to hold dollar cash, is to invest in the system. And if the system's going to fall, then you're going to have to get out of all credit, which includes the US dollar, and get back into money. And the question is, what is money? And people have been so polluted as to what even money is that nobody knows what it is anymore. And people think that money is stocks. People think that money is debt. People think that money is bonds. Worse, people think that money is nothing. It's just a point system, or that it's Bitcoin, a series of numbers in a chart that for some reason people think have value, but they don't realize that everything is connected to the past and all prices are connected to the past. So the simplest definition of money is the most liquid physical commodity that exists in an economic system. And because it's liquid, you use it to trade for other things. Because the reason that it's liquid is that it stays in the same form, and that its value changes the slowest versus everything else. That's what makes it liquid. That's what liquidity is. So money is liquidity, and the most liquid thing is the best money. So what I am telling my followers is get out of credit and get into money, which means precious metals that you can actually have access to, and not credit derivatives of precious metals, which I'm not against entirely. I own some credit derivatives of precious metals, like ETFs. I own some of that. But in the end, I don't think those will survive either. They are good vehicles through which you can earn more credit through using them, and then use that credit to get money if you want to play that game. But ultimately, you have to get out of all of it. And then once it all falls, then you can redeploy your money back into a credit system that will grow on top of it, but a more honest one that isn't so inflated with a bunch of garbage that we have now.
Gold and silver are beginning to reclaim their historic roles as real money. For years, mainstream equities outshined metals, but that balance is shifting. As inflation persists and central banks pivot toward rate cuts, investors are rediscovering assets that don't rely on faith or digital promises. Unlike fiat currencies or bonds, precious metals cannot be printed or defaulted on. Their resurgence signals something deeper, a collective move away from credit-based illusions toward tangible stores of value. This return to fundamentals isn't speculation, it's survival. When the measuring stick itself, the dollar, falters, true money shines brightest.
Expect that valuations will go up and down more and more in a more and more volatile way because the unit on which they are counted and valued, which is the US dollar, is getting more and more shaky. So you'll see crazier and crazier rallies followed by crazier and crazier sell-offs, and this will get more and more and more volatile until the very unit with which we measure these things collapses entirely. So when you ask me about the valuations of stocks, um, my answer is nobody knows what the valuations of stocks are because the measuring stick that we use to value them is sick, right? If you're gonna tell me how far is it from my house to the nearest supermarket, and then you give me as a measuring stick something that keeps wildly changing, shrinking and growing like, wildly every second, I won't be able to tell you how far it is from my house to the supermarket. So any answer I give you won't make any sense because it can change the next day based on my measuring stick. All right. So there are no valuations of stocks. They're all an illusion. Everything is an illusion. Nothing makes any sense. And this is all going to hell.
The U.S. dollar, at its core, is an instrument of debt. Every note issued represents a promise tied to a treasury bond. Investing in dollars means investing in that fragile loop. But when the foundation of credit weakens, holding cash becomes a liability. Valuations across markets, stocks, bonds, even property, become distorted because the yardstick used to measure them keeps shrinking. Just as a broken ruler can't yield accurate measurements, a depreciating currency can't define real value. The truth is, most of today's asset prices exist in illusion, sustained by confidence alone, not substance.
They should be lower or they should be higher because what are you paying interest in? Again, you're paying interest in a unit that doesn't make any sense. So whether they should be higher or lower, they shouldn't exist because a treasury is a vehicle to pay future dollars in dollar terms based on a dollar that's already existing because it bought a treasury. So you're talking about a self-reinforcing loop. The treasuries are units to pay future dollars, which themselves are treasuries, which themselves are dollars, which themselves are treasuries, and so on and so forth until the whole thing spirals out of control. So should interest rates be higher or lower? I know that these aren't like the answers that you wanted. You wanted me to give, a number, what interest rates should be. Well, I mean, we could play that game. Let's say if interest rates are, let's say, 20%, what would that do? That would collapse the banking system. Well, if interest rates are 0%, what would that do? That would collapse the dollar. So it's one of those two. One of those two is going to happen. It's not going to be collapsing the banking system because then the bankers will get very upset. Instead, it will collapse the currency, and that will collapse the bankers because when the bankers have no more dollars and their dollar can't buy anything, and they have banks full of dollars, they have nothing, and then they'll collapse anyway. End of this, no matter where interest rates go, higher or lower, means the banking system is going to collapse. And when the banking system collapses, that means everything is reset. All valuations of everything will be reset to money and not to credit. And the question is, who will have the money? And the answer is whoever has the gold and silver. They will be able to use their liquidity to acquire whatever capital remains, and everything will be redistributed based on who has the money and not who has the credit, because the credit will be worthless.
Every financial cycle ends with a reckoning. As global debt spirals and volatility intensifies, the next collapse will likely reset values not in terms of credit, but in terms of real money. When the banking system breaks under its own leverage, credit will vanish, and liquidity, gold and silver, will determine survival. Those holding tangible assets will acquire what remains, while those dependent on credit will be left with numbers that no longer matter. It won't be the end of civilization, but the start of a new monetary era, grounded once again in something real and finite.
Leverage-wise, first of all, I think you should always have physical metals first, even though I'm singing to the choir. But that would be whether I was talking to you or anybody else. Physical metals, you have to have some insurance. After that now, from this point on, let's take gold's at 4,000. And let's say it goes to 5,000. That's going to be a 25% gain that you had on the gold. I can assure you almost every major producer will see its stock go up triple or 4 times that return because 98 or 99% of that gain will go to their bottom line. Their cost doesn't increase dramatically just because gold went from 4,000 to 5,000. So the real leverage is in the producers of the companies. And you're going to see, we're already seeing it, but you're going to see just bigger and more M&A in that industry. Then, of course, the drip down effect hits when the junior resource companies, who are still not participating in any major way, but as some of them start to merge or be taken over by these majors, they'll have their day in the sun as well. So yes, mining shares over high-risk junior resource stocks, but both of them can outperform the physical metal because the leverage that'll be offered to them will be greater. But with that leverage opportunity comes higher risk. So you have to measure both your mental and financial tolerance before you participate in that side of the market. And think about this. So right now, the average gold producers, some say, is between 1,200 as little as 1,200 to maybe as high as 2,000 as their total in cost. That's what it costs them, and then whatever they get extra for that. Well, now they're getting twice as much as that, but $1,000 more would be 150%, and their expenses aren't going to go up that much during that time. So that's where you see the real leverage. That's, as we like to say, a lot of us have been saying that follow them. They've been legally printing money with record free cash flow, and that's only going to continue more and more here for the next several quarters.
In times of crisis, gold miners often outperform the metal itself. When gold's price rises, most of that gain translates directly to a miner's profit margin. For instance, a $1,000 increase in gold can triple or quadruple mining stock valuations. This leverage has already sparked a wave of mergers and acquisitions across the sector, with major producers expanding aggressively. Junior exploration companies, though riskier, stand to benefit next. But with greater reward comes greater risk, and investors must weigh both emotional and financial tolerance carefully. Physical metals remain insurance. Mining equities are the speculative multiplier.
You know, it's funny. I left the metals and mining industry in 2013. Never thought I'd be back involved in it. Have been involved in this financial planning group here in New Jersey. We manage over $1 billion. And I kind of got my toe wet in 2019. And by 2022, I was full-fledged back in. I don't work as a IR or any of that kind of stuff. I had a blog that had some sponsors, but I found myself getting away not only from the general financial planning group, but also the faith and finance, which I believe the only reason I'm still alive, Elijah, and probably why we've come together, because we both share a strong belief in our Catholic Christian faith. And so with the tremendous gains that we've had, I've had the best 5-year period ever in my career. Clients who chose to listen would have done just as well. I just felt that it was time in the latter stage of my natural life, approaching 70 years old come April, that I need to refocus back on the faith and finance. And therefore, by year's end, I will not be involved in the junior resource market, no more blog sponsors, things of that nature, and trying to speak more about matters of finance from a biblical perspective than what some junior resource or stock may or may not be doing. And that'll be the big change compared to the last 3 years.
Beyond profits lies a moral reflection. Our debt-driven system isn't just an economic failure, it's a spiritual one. No sacred text glorifies debt, instead all warn of its enslavement. True wealth isn't measured in digits or net worth, but in stewardship, how we manage what we've been entrusted with. The modern obsession with endless accumulation has led us astray. As the old system crumbles, perhaps this collapse offers renewal, a chance to align finance with faith, ethics, and balance. In the coming transition, those guided by wisdom, restraint, and compassion may emerge richer in ways money can't measure.
Those of us who tried over these last several decades looking into a crystal ball, the only thing we became experts in is how to eat more broken glass. So we put our pant legs on one leg at a time like everybody else. But one of the things that's real important to me is that in the faith, if you take a biblical perspective, Protestant or Catholicism or even in Judaism, there's no support of the biggest thing that Americans have got hooked on, and that's debt. That's the reason we're in such a huge problem with $37 trillion in national debt, consumer debt, corporate debt, and yet no teaching of faith that I know of, certainly from biblical proportions, has supporting of that. In fact, it's full of warnings about what that can lead to. Now, I've been on that kick for almost 25 years. Wherever I talk to people, they say, what's the best investment? And I say, pay down your debt, get out of debt and all. And that's going against the principle because consumer debt continues to expand and all. But part of that is also the fact that whatever or who's ever in charge for the coming years, those of us that still have something left, the wealth, are going to be kind of trying to be taken from, because more and more people are going to need it, because the government just takes from one group to kind of give to another. And one of the things that I also believe that it teaches us that, yes, we have to be prepared to be willing to help others, but we need to do that by being as efficient and effective on what we have. And typical financial planning doesn't do that. Typical financial planning, which used to be a pad and a pen when I started, and now it's computer programs with 400 pages and all sorts of graphs and all. But basically, it's chasing net worth. It's on the principle that Wall Street has, that more money will equal more happiness and solve your financial needs. But in order to do that, you have to take risk, trying to hopefully a past investment product performs as well, if not better, to reach that goal. And what we find in my work is that most people are not cash flow literate. They're illiterate. They're not effective for what they have. So first, being efficient and as effective as you can be on what you have is a guiding Christian principle. And I'm not in the group, by the way, because there is a sect within, primarily in the Protestant community, but there are some Catholics that fall into it as well. And that's the Christian prosperity, that we're all supposed to get as rich as possible, and that God wants us all to be rich as possible. God does bless, and there's people in the Bible that he loved very much that were wealthy, but he puts a much extra burden on those of us who are gifted with extra wealth. And part of my work is trying to get people to recognize that you're called more as someone with some wealth to help than some person that's just, getting by. And that's the difficult thing. That's why Jesus uses all sorts of parables, from the rich man to the lady with just the coins and all, to try to teach us that we're not to get attached to money, and hopefully that, for what remains of my natural life, I can get more back into that, because I lost myself in this metals and mining boom. And don't get me wrong, it's been highly profitable. And there's really no one that would be mad, but I really think it's time that I need to do more of the faith and finance and less about metals and mining and stocks and things of that nature.